There are two types of income. There's what we call rental income and other income. So we look at the rental income separately than all the other income, because the rental income is comparable from you can compare it to other properties down the street. But the other income that comes in is usually unique to that particular property. So that's why we break up rental income and then other income. And remember, what I talk about is we have the other income. Within that category, we have two other categories: good income and bad income. Okay, we're not going to talk about the other income right now. All we're going to talk about is the rental income. So when we break down rental income, we start at the very top, which is the gross potential. This is never land. This is where nobody ever hits it. No one ever is delinquent. No one ever dies. No one ever gets divorced. No one ever moves out. Everyone pays the top dollar for rent. And that's the gross potential. But you can't pay your bills on the gross potential because you never have that amount of money. You pay your bills on the gross collected. That's the money that is actually in your bank account. But accountants account for all of these categories because they help you understand how to run your property. It's the basis of managerial accounting. You need to know this information so that you can figure out exactly how to run your property. So the difference between the gross potential and the gross collected are categories of income that we call income reducers. They bring you from never land to reality. And by breaking it up and giving them different names, you know what's going on that property. You know how to manage that property the right way. So this particular student asked me the question, well, what exactly are income reducers? Can you give me a breakdown on that? Well, here are some of them. Loss to lease. That's what you should be getting for your property versus what you're actually getting for your rental, your one bedrooms, your two bedrooms. The difference between the two, that's loss to lease. Well, you might be thinking to yourself, well, why categorize that? Why do we even keep track of that? Because it helps us understand how well we're marketing our unit. It helps us understand what type of things we need to do in order to get that extra, or how hard we have to work in order to get that extra money. So that's a first example of an income reducer. That brings us down. Then we have physical vacancy. Remember, never land, all of our units are full. Reality, it ain't like that. We have vacant units. We have people that move out. We have people that skip. All those types of things, we have vacancies. Now we break down the vacancies in two categories: physical and economic. Well, why? Well, because each one tells us something different about how we're managing the property. Physical vacancy means we got to market more. Economic vacancy means when we market more, we have to screen the people better and not bring on the deadbeats. Then other things are in there, like employee units. There are going to be some units that you never can rent out. Sometimes you see these people using rental units as storage units. Like the owner is sticking, hey, that unit's a down unit, so let's start putting stuff in there. I got a better idea. Why don't we go turn that unit around, start bringing in $7,000 a year of income, and capitalize that instead of letting it just sit there as a vacant unit. It just doesn't make any sense. But that's part of what we're seeing. And the same thing is true with employee units. You got to figure out, you got to account for that lost revenue. And it shows up as an income reducer. And then finally, concessions is one that we always talk about.